Could stock market insiders be selling up their positions? In today's video, we explore the latest data and why this tweezer pattern may have more impact than you think to markets as they hit correlation levels. Whether it's semiconductors, Tesla, or even Nvidia as a stock, everything's hit what we call a call wall. And in today's video, we need to talk about the options flows and what we expect to happen next. VIX is spiking, geopolitical tensions are rising, and at the time of this recording, it looks like there's a lot of pizza orders going through. What exactly is about to happen? Well, we're looking at everything from stocks to commodities to cryptos to break it all down right now together. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we'll be covering the latest macro, the big data, and of course the key flows, including a couple of large dark pools that came through over the last 24 hours. Let's kick things off though with insiders. It looks like, as of the latest data that we have so far, insiders have been selling at record levels. And we've just not had this before when it comes to this total size, even since 2005-2006 period. And you'll notice that while it doesn't necessarily coincide with the absolute highs of markets, what it can do is show the beginning of the final run. And this makes us think, well, maybe we need to be a little bit more patient, a little bit more clear-headed when it comes to picking our stocks over the next 6, 12, and even 18 months. As we already know, social media, according to the latest Goldman Sachs report, is absolutely flatlining at the top here in the roof. And that basically means that there are no bears in terms of general sentiment out there when it comes to social media. Could this cause at least a little bit of a panic sell that Wall Street starts to pick up on again? Well, it certainly could. And we've already looked at the fact that institutional buyers have started to pick up their positions a little bit recently, but they're still behind. And as we know, Wall Street hates to be behind because when they underperform, they don't get bonuses. So what do they like to do? They like to push the stocks around so that they can buy that dip on the better prices. We do know that retail went all in on this bid. It was one of the most aggressive buys we've ever seen from retail, as we've been conditioned that way. And recently, a few retail traders have started to sell off. So if we do get a little bit more of a sell-off, it will probably create an extreme amount of fear. And I would say retail will absolutely start selling the bags across the board. What have you guys done though? Have you started selling already? Are you ahead of the curve? Or are you just saying, you know what, I'm going to hold back and chill here? Now, one of the reasons why I think a lot of this is happening is also to do with the second half of June. If you're not aware, over the last 70 years, it's really been the weakest period of the market. And the second half of June is the point where generally the market will sell off, and then we'll see an uptick into July. Notice the first half of July, it's the number 1 2-week period. So you really want to own stocks during the beginning of July and technically be more a buy the dipper during the back end of June if you can do so. Could we be hitting a 50 daily moving average? That's one of the big levels we'll look at later on today's video. What about big dark pools? This is the kind of trade that obviously big Wall Street players go with each other and they actually say, I want to do a deal, and they do it off market and then report it at the end of the day or some period during it. Now you can see here there were a cluster of trades that came through on PLTR. And PLTR has absolutely been going ballistic recently to the upside. Many of you would know it's probably disconnected from a lot of fundamentals, but it is a momentum trade, and momentum trades can go further than most people think. Now, why is this important? Well, this is a 2 times levered version of PLTR, and we just saw a whole bunch of clusters, 2 retests back to that level, and then a sell-off. So this kind of tells us that at least somebody most likely sold at least a position there, and that they have started to take some profit. You can also see here that geopolitical tensions may be about to rise again, according to the latest Pentagon pizza report, which, yes, we are actually looking at now in 2025. There is an unusual amount of pizzas being ordered close to the Pentagon. Whether this is real or not, who knows? How does it work out? We don't know, but it has been synonymous with kind of geopolitical tensions rising due to all sorts of different things going on. So certainly we are watching pizza reports. It's now becoming a well-known thing, but we'll see how it ends up playing out. Hopefully it's nothing. US housing affordability. You can see here, guys, that US housing affordability hasn't been this bad since the 90s and just before the global financial crisis. And this has median home buyers now almost upwards to 40 years of age. We're at almost 39, about 38 years right now. So it means that most people buying US homes are now kind of like realistically getting closer to the back end of their careers than they are the start. And this is one of those big things that we're seeing across all of the Western world. It's become unaffordable to own homes. And of course, people are going into more debt. And that debt could be one of the problems that we really have blow over, especially through deregulation over the next couple of years. And that will be a topic we talk a little bit more about. The evolution of the Atlanta Fed GDP now versus real GDP estimates. We've already seen this be a little bit wrong this year. We had the Atlanta Fed go ballistic and say that the GDP was going to fall through a floor, literally, when it came to the tariffs. Then what happened was we, of course, got a revision of that and the GDP came in a little bit better. The way tariffs usually work is they create an initial demand. The initial demand then creates a very strong looking economy. It then kind of flatlines and then eventually supply overtakes demand as orders have come in thinking it's all going to be good, and it's not. The longer the tariffs stay, even at 10%, which is obviously a little bit more across the board, the worse it's going to get for the US long term. But of course, it takes time, upwards of even sometimes 12 to 24 months for tariffs to actually work through the system. Now, according to the Atlanta Fed, we are still looking at growth, thanks mostly to AI in terms of the US, and also this economic stimulus that's coming through because everyone's trying to get ahead of the tariff increases on some products. Pre-COVID levels, according to the latest Fundstrat data here, you can see that the inflation levels, at least for now, are sitting around 2.38. And this becomes important when we consider the Fed's next move. Will the Fed cut, as Trump wants, or will the Fed just kind of sit there and do nothing? Well, according to the latest data, the chances of a cut right now are pretty slim. But the chances of a cut here later on this year are going to increase quite a lot. And most people believe there is upwards of somewhere around a 15% July cut right now and 75% cut rate in September. So it does seem likely that the next move by the Fed is going to be a cut, but it's unlikely to happen this meeting. It's really going to be more about the press conference after the report from the Fed, and then we'll have a bit of an idea on what the Fed's planning on doing next. In our previous video, we discussed the idea that maybe Treasuries will get QE at some point as well, and that could lead into a big buy-up. So there are a few things happening in the bonds market, and maybe that's all going to be around that September period. We'll have to find out. FMS, most underweight in the US dollar. Recently, we've had a bit of a flight from US equities. We've seen a lot of world money start to flee and push out, and that's kind of starting to move at a little bit more of an accelerated rate. US dollar is obviously not in super demand right now, but anyone that thinks the US dollar is over, generally it takes a very long time. So remember, while we've been negative on the US dollar since January this year, we aren't negative on it because everybody's fleeing from it like this. We're just seeing it as the normal period of the cycle. So what that basically means is usually this is the time more for international markets. We've seen people go into obviously China, India, Europe as well. Even emerging markets are starting to fly a little bit more, and we are just seeing money flow around the world, which is not the different. It's a bit different to what it has been, which has just been US exceptionalism for the last 10 plus years. US economic financial outlook, according to the latest Goldman Sachs survey, and they're pretty bullish generally in the markets. They actually believe that jobs numbers are going to get a lot worse in Q3. So just remember, if they expect something, it isn't a surprise. It's when a number is different to what they expect. So they're actually saying that jobs growth is going to slow. It's still going to be growing, but it's going to be a lot slower. Now, if we keep seeing slower growth like this, then a rolling 12-month will actually be quite low. And a rolling 12-month job creation at a really low rate, that starts to call recession signs. And I know everybody is saying 17% chance of recession, but let's be real. They go from 65% chance of recession to 17% chance of recession in 1 month. It's ridiculous. So you never really read into that. The key here is going to be the jobs numbers. If they sustain and run on a 12-month roll where they look negative. And I'm, kind of looking at that number, and we'll be paying a lot of attention to that one. So the latest economic outlook doesn't look too good. What are some of the gains that the market could look at? Well, of course, AI leading to jobs literally being lost in the tech sector. Obviously, corporate profits will go up. One other thing here is that the big, beautiful bill between the House and the Senate, how does it compare? You can pause the video and have a look here. So obviously that tax cut for kind of the higher end there could be good for corporates, at least initially, give it a sugar rush. And of course, we've got deregulation and the possibility of QE from the Fed in the future, which has already been partially hinted to. Now, I've discussed the idea of the 200 to 250 days, and that's going to fall kind of bang in the area of just after that kind of normalized July run. Now, will we get a sell off similar to other big reforms in terms of where we saw big changes to the overall taxation policies and all sorts of things? That's going to be an interesting one. We don't know yet. Obviously, we have so many things coming at us that we're not exactly sure where we're at in terms of the exact layout right now. But if you had to guess, you would go with the 90s or you'd go with the 60s period. And in both of those, we were later in the cycles than most people thought. So I would liken the current boom in AI similar to the dot-com boom. And I think we're starting to get IPOs, which are quite popular. So these IPOs are in crypto markets. These IPOs are in AI markets. And that's what I was looking for. And we're also seeing a lot of IPOs in both, like a kind of crypto finance market as well. So what's happening right now is exactly what I would expect in a mid to later cycle where people just get FOMO froth, start buying IPOs with no consideration. And that's the typical way that things go bad. Do you remember 2021? I certainly do. Of course, that was the time of SPACs coming through. They were really quick to list and they were listing at bonkers pricing. That's the type of euphoria you usually need to see at any top peaks in markets. Speaking of which, we've been big fans of gold for a couple of years. Obviously, everyone now likes gold, though Citi did downgrade gold just over the last 24 hours. But gold has actually been the best performer in terms of the majors here. Now, NASDAQ might be, doing a little bit better in terms of getting up there, but gold's actually performed quite well since 2000. You can see here it's gone in a couple of runs. Thing with gold, it's all about timing. So right now, we're big fans of gold, silver, and also Bitcoin. And that's because of this type of thing, which is geopolitical tensions, but also central banks just buying it out of control. Now the second largest currency that is being held by central banks. So you've got to think if central banks keep buying, there's no real reason why gold has to permanently stop. It's just going to be up, down, all around as it slowly grinds higher over time. Oil moves up generally during conflict. Obviously, we know it spikes usually, then it drops. Then if it keeps going to escalation, which it currently is, then we usually get back up at those peaks. So that's the type of typical way we see oil move. But I just want to bring this chart back up again. In terms of Iran's oil, we generally see it go more to China than the US. So the US is not as, I guess you would say, susceptible to this particular flow as many people think. And that's why, in many ways, the markets have held better than you would think. Weekly crypto asset flow, as we mentioned in the last video, there's been quite a lot of overall flows into Ethereum and Bitcoin. That's been a net positive. Now, we're still seeing them struggle with key areas, which we'll look at later on today's video. But obviously, we do want to be paying attention to that. And the question then comes back to, are we seeing distribution, which is a sell signal, or accumulation, which is a buy signal? The number one and number two largest dark pools came through, and we're still trading above that zone. So basically, we are right at the point where we're going to see a fairly large decision on Ethereum. And I'm certainly watching it with all eyes open. And of course, we'll be sharing that every day here as we start to see more information play out. In terms of central bank liquidity, as we always follow on the show here, we've got Fed and the World Central Bank in general kind of accelerating their liquidity providings, and that's helping to support the markets. But the real question, I think, now is going to be, do we see this end as a tweezer? So do remember at the start of the video, I had this one. It is certainly an overbought market signal. It is looking like a tweezer, but remember, this is a weekly chart. So have we closed? The answer is no. Are we coming into OPEX? The answer is yes. And historically, we see a lot of vol on the Thursdays. So we've still got a little bit of play here. This is obviously a very Sally style signal. You don't often see tweezers hold, but we don't know it's going to look like this. It could reverse and look totally green and be all good. So don't read into that too much. The key levels to look at is going to be 5,900 in particular. And you can see here in the futures market with the updated high-low options levels, we're kind of stuck in the range. So we haven't actually come down and tested the lows yet. Key anchored VWAP also around 5,920. That's going to be a key zone between 5,920 to 5,900 on the options. And then, of course, underneath that level, we're looking at more of a 5,800 style area. And this becomes quite aware when we look at all expirations. And I want to do all expirations because Oftentimes, we just look at the kind of next week, maybe the OPEX, but have a look here. 6,100 became incredibly struck. Obviously, 6,000 is a big deal where we kind of find ourselves. And then we've got pretty much 5,900, 5,800 being the number one put strike at this stage, and 5,950. So we've got a couple of levels. Come on over here to the more recent data. And you can see here we're at 5982. If we fall, 5960, 5950 actually level here, and 5900. So both of those levels will matter. And as we come into the OPEX, you'll notice that we have again 6,000 both sides. So the market's kind of neutralizing around the price it's trading at right now. If it does come down to 5950 or 5900, you have to expect possible bids at those prices. And of course, we lose 5900, we're going towards 5,800. And there are even some puts probably left over from other things that are sitting now in the 5,000. So there's quite a lot of random puts and calls floating around. It reminds me a little bit of that Tesla call that's sitting at $900 that just getting absolutely obliterated at this stage. Nvidia, as we mentioned, it's all at a call wall. 145, 150, 145, 150. Very difficult to buy it at 145. You just probably wouldn't do that. You'd wait for the 150 to break and then use it as a momentum trade technically, and we just haven't seen that. It's the same for Tesla. 330 call wall, another kind of win, I guess, for the call wall because we hit that level and then we just rejected it. So we didn't see any close above. We weren't, of course, feeling bullish at that level until it broke through for 350, and now we're pushing down. So we've actually seen 315 become the next put this week, but I would think that, the real support for this stock seems to be somewhere in the 280, 275. So although it's not down that low, I don't know what's going there. I always say patience in these cases and look for the edge. And in this case, I don't think there's much edge in the middle of nowhere for Tesla. Maybe you do. Maybe I just don't see it. Let's move over here to Treasuries. US yields did drop over the last 24 hours. And we do have, of course, the old inverse head and shoulders pattern, which most of you guys can see. And this is kind of pointing towards possibility of 90 for Treasuries. I don't think Treasuries have a massive catalyst yet, but everyone hates them. And everyone hates them. I mean, everybody does. And that's kind of, as a little bit of a person that likes to go against the trend sometimes when I see patterns going there, it kind of gives me confidence if the pattern looks good. The main thing, though, is going to be probably what does the Fed say? This is all about the Fed and all about QE, because obviously it's going to be yield dependent. So at the moment, no one sees US Treasuries as being a safe haven like they used to, and it's not acting that way as you usually would see, and everyone is treating gold as the new safe haven. So it's an interesting one. Treasuries, we will need to track that very closely because now it's actually at an interesting flow point. Looking for big dark pools, and we'll update if we get them. Copper, nothing much changes here. No closure above 490 means we don't have a strong flow to the upside just yet. And we can see here that bonds and kind of risk is not realistically spiking. So even though there's all this stuff in the news, we're just not seeing extreme fear approach in the markets yet that would be synonymous with a significant top. So if we do see sells at this stage, it looks like they are probably more of a hedge fund or institutional buying opportunity to try to get some catch up here in the markets. Dollar index, as you can see here, guys, a little bit of a pickup, looking towards 99 to potentially see sellers again. And I'm still pretty bearish on the dollar, but I think I can see why it would, resume a little bit up. Gold, nothing good here in terms of buyers yet. We're looking for 34.05 at minimum to get back above and actually start pushing higher. But it is still holding a series of higher highs and higher lows. So no real problem on gold. And silver was the win of the last 24 hours. We are loving silver at the moment. It's been pretty nice. And a lot of you have messaged me saying, man, silver is absolutely flogging. And yeah, it was one of those trades that I think is a mixture of replication. It's also a mixture of the right time and the right place. Obviously, silver is generally trash. So don't get me wrong. If you're a silver bug out there, I'm sorry. Often it is trash. It has been trash for years. We all know this. And it's all about timing. And this actually had an excellent replication trade in here that we were talking about. So very nice. I'd like to see silver continue on. Obviously looking into the 40s for this. And ideally it would go to like 42, 43. That would be pretty sweet. In terms of US oil, what have we got going on? Well, we just have an increasing market here that's going back to test these highs. That is kind of the way that it often does trade, as we've mentioned. It's probably starting to peak out, but may go up to 79, which is for some people the thing. I don't really believe oil is worthy of trading, because the problem is, if you're lucky enough to be in it early in terms of just the trade action, that's fine. But now it's very gamblery. It can go up or down like 5-10% in a day. So just be aware there are risks here. It's incredibly geopolitical, and obviously it's going to be one of those evolving stories. So do I think it could spike up to that 79? Yes. Would I trade it? Probably not anymore. Yeah, we'll see what happens. Tesla, 330, too much. Calls win again. At this stage, nothing much going on. Now, we did see, of course, analysts regarding anticipation launches of robo-taxi services and all these types of things come through in the headlines, but really it just flows, and 330 just too much for it. If we do close above 330, 350, 360 becomes the next level. And Nvidia, again, at that resistance. So 145, 150, 145, 150. We've mentioned it a million times. Semiconductors also just creating what we call a pit or a pullback in time. So there is really no movement here in semis, no movement here in the major market kind of reads that you need to push us higher. That's why we're seeing consolidation and a little bit of a sell-off. US 2K is also similar, just sitting around support at this stage. Of course, if the rest of the market sells, you're going to see the 2K come back down into 2040 area. But for now, it's kind of at that 20 moving average, which it's historically found buyers. So yeah, no momentum shift, but certainly is there. And you can see here, NASDAQ still looking at that 21,460 support, and that's going to equal 59.20-ish on the S&P. So it's just totally neutral. I would be neutral, maybe slightly tinge of bearish, even though the trend's up. If I'm looking short term, if I'm looking medium term, of course, short term meaning days, maybe. If we're going medium, weeks, you have to think, well, okay, maybe June's going to be a little bit negative. As we know, second half is bad, but July is the best 2 weeks of the year. So, worst 2 weeks followed by best 2 weeks traditionally kind of makes sense for now. What about Ethereum? Must get above this area here, 2,700. A closure above there is going to be a big deal. This is really on the edge. It's a Wyckoff forming either way. So we're either going to see maybe a low steal as well. I mean, there are a lot of different opportunities here. This is a classic reaction trade. So I'm watching very, very closely. We're trading around the right area, but we haven't seen the buyers come in yet. And the same thing's going on here for Bitcoin. So pivotal zone for both buyers and sellers. This is the absolute area where there is a lot of clear, I guess you would say, equilibrium. The markets are not sure which way they want to move. Of course, you generally go with the direction of the recent trend, which has been to the upside. So you're going to be slightly more biased that way, 60-40. That's the right thing to do. But we're open and we just don't know which way. And that's why we often say patience, react, don't predict. These are very interesting trades. They remind me a little bit of the oil trade recently. And also that time we had to switch on the NASDAQ to go bullish again off the Fed, funnily enough. Speaking of the Fed, we do have their announcement coming. Well, we have to scroll down here a little bit. But you can see that on the 18th, 18th, yeah. On the 18th, we have the federal funds rate, which is expected to be 4.5. And then we've got the FOMC statement and press conference. Really, this one's probably going to be about the press conference, which is half an hour. So that's 2:30 p.m. New York time. That's going to be important. We know that September meeting is probably the big one here. But they're all always, of course, able to move the markets. Guys, to summarize the markets right now, I would say that the geopolitical hedges look a lot more bullish than bearish. Obviously, oil is very, very tough now in terms of making good statistical decisions. It's very, very volatile. And the stock market itself just looks, pretty overbought. And again, going into the 2 week period, but we're just not seeing those triggers to say, okay, we can move towards the daily 50 or any of those things. So very neutral for now. I know that isn't always what you want to say, but sometimes the best thing is to look at the markets and to recognize that there is a coiling style market. If you enjoyed today's video, please remember to subscribe, smash that like button. And obviously, if you're from Melbourne, Australia as well, 2nd of July, we have a special trading event. It's going to be super awesome. It's free to attend. Links in the description down below. Make sure you can get there if you can. And we will see you later. Bye for now, guys.